Unit 5, Chapter 12, the Capital Budgeting Decision, Part 3. So we ended Part 2 on the selection strategy. And here's one more screen for your review before moving into the reinvestment assumption. So, the reinvestment assumption is about the modified internal rate of return is an alternative calculation to the IRR and NPV methods. All cash outflows are discounted to the present at the firm's cost of capital. All cash inflows are converted to a terminal value by compounding them at the firm's cost of capital out to the end of the project. The discounted rate that equates the future value of the inflows growing at the cost of capital with the amount invested is the MIRR. Table 12-9 in your text demonstrates the method for calculating MIRR using the rate function on Excel. Here is a graphic example of the reinvestment assumption of IRR in NPV. Here we're reviewing that the modified annual rate of return combines the reinvestment assumption of NPV method with IRR method and the discount rate that equates the final value of inflows with the investment. This is a graphic depiction of the MIRR for investment B for your review. We're moving on now into capital rationing. Management may implement capital rationing by artificially constraining the amount of investment expenditures. Under capital rationing, some acceptable projects may be declined due to management's fear of growth or hesitancy to use external financing. Under capital rationing, projects are ranked by NPV and accepted until the rationed amount of capital is exhausted. The net present value profile. The characteristics of an investment may be summarized by the use of the net present value profile. The net present value profile can be used to reinforce the inverse nature of required rates of return and present value interest factors and the resultant impact on discounted cash flow streams. The NPV profile provides a graphical representation of an investment at various discount rates. The three characteristics of an investment are needed to apply the net present value profile. 1. The net present value at a zero discount rate. 2. The net present value of the project at the normal discount rate or cost of capital. And 3. The internal rate of return for the investment. The rules of depreciation are based on the Tax Reform Act of 1986, which created a classified 8 different categories that determine the allowable rate of depreciation. Each class is referred to as an MACRS category, which stands for Modified Accelerated Cost Recovery Range. There was an article in your text called Finance in Action, Real Options Add a New Dimension to Capital Budgeting. and it discusses rail options not considered under traditional capital budgeting decisions. These rail options include intermittent decision points throughout the project. These decision points provide the opportunity for the firm to continue or revise the project plans or abandon the project altogether. This sophisticated technique is not widely used, but is expected to increase in the future. Here is a graphic depiction of all of the categories for depreciation write-off. Here we see depreciation percentages expressed in decimals for your review. Here we see a depreciation schedule so that you become familiar with this. And here's an actual investment decision example. If you assumed $50,000 depreciation of machinery with a 6-year productive life, it produces $18,500 of income for the first 3 years before deductions for depreciation and taxes. In the last 3 years, income before depreciation and taxes is $12,000. The corporate tax rate is 35%, and the cost of capital 10%. For each year, the depreciation is subtracted from earnings before depreciation and taxes to arrive at earnings before taxes. Taxes are subtracted to determine earnings after taxes, and depreciation added to earnings to arrive at cash flows. Here we see cash flow related to the purchase of machinery for your review. Here we see the net present value analyses. The replacement decision is an investment decision for new technology and includes several additions for basic investment situations. First being sale of the old machine and the tax consequences. And then it can be analyzed by total analysis of both old and new machines, or incremental analysis of cash flow changes between the old and new machines. The sale of that old asset results in cash inflow from the sale of the old asset based on the sales price and related tax factors. For tax factors, book value of an old asset compared with the sales price is used to find the taxable gain or loss. The loss can be written off against other income for the corporation, and a gain is taxed at the corporation's normal rate. This shows you the book value of an old asset and the net cost of the new asset. Here is a graphic depiction of the incremental depreciation benefits. Cash flow analysis is on the basis of an incremental gain in depreciation, related tax shield benefits, and certainly cost savings. Here is the cost savings benefit illustrated for you. Here we see the present value of the total incremental benefits. Lastly, there's something called elective expensing. Under the 2008 Economic Stimulus Act, firms have the option to write off the purchase of equipment, furniture, tools, and computers for up to $250,000 in the year they are purchased. This provides a cash flow advantage by deferring taxes to future periods. The allowance is phased out dollar for dollar when total property purchases exceed $800,000 in 1 year. Here we are at the end of Chapter 12. I hope you've enjoyed these PowerPoints and audio lectures, and I will see you next unit.